Great. So welcome you all to today's section. I'm going to look at the question solving of IAS 16, especially the measurement of IAS 16. Some specific questions that we need to get it done. So we first of all scan through the material, the big questions, and then we just sit with it. Okay, so let's go to illustration 12 or to talk question 9. Illustration 12. That is where I'll start from randomly. Okay, so this is illustration 12. Let's go to the requirement. Prepare the extracts from statement of comprehensive income, which is income statement, and statement of financial position, which is balance sheet. For the above machine for each of the 3 years, 2012, 13, and 14. So let's see the question. On January 1st, 2012, Samantha Company acquired a machine under the following terms. Samantha acquired machine under the following terms. Under the following terms. So, manufacturer base price, everything, all of them are there. Let's go to the notes. Estimated life in machine hours. So this is machine hours. Depreciation is being calculated using what? Machine hours. That is it. And that's 6,000 hours. Hours used. So the first year is 2012, 1,200, 2013, 1,800, and then for 2014, see below, even though they use it for 850. On January 2014, and so if they are saying on January 2014, then it means that it will affect what? Just 2014's financial statement. It will not affect 2012 or 2013. So for 2012 and 13, you are free to do your calculation without this. So on January 2012, Samantha decided to upgrade the machine by adding new components at a cost of 200,000. This upgrade led to a reduction in production time per unit of the goods being manufactured using the machine. The upgrade also increased the estimated remaining life of the machine. At 1st January 2014, 4,500 machine hours, and estimated residual value was revised to 4,000. So let's go straight to the solution. Don't forget that the main solution, the examiner asked for the financial statement. So you start like this. That examiner that shall be prepared for who? Samantha Limited. A good ghost. Samantha Limited. Okay. So you have Samantha Limited here. Then what you do is this. Tell examiner that is a statement of comprehensive income. Statement of what? Comprehensive income for the year ended. So 2012 2013, and 2014. Don't forget your currencies. Reporting currency. In this question, the reporting is series. So that is it. Now, don't forget that we are scanning through some complex questions under IAS 16. It would be very good or very nice if we are done with a particular 3 standards because they relate together. So I will still solve certain questions again. IAS 16, IAS 40, IAS 36, especially 16 and 36 impairment. They are just close friends. And then their related party is this, and then their junior brother is the 38. So we have to look through this. So as soon as we are done with this standard, at least we'll pick questions that have double standards. So we'll be moving between standards. Like today, we'll solve a particular question which have those features. Okay. Then we'll go to the financial position. So you leave space here. Then I'll come here. So Samanpa Limited. Samanpa Limited. Third examiner. That is a statement of financial position. Please, no shortcuts in exam. Statement of financial position, no shortcuts. You put 2012 here. You put your 2013 here and 2014. Don't forget your currency. Please, this is what examiner asks. So that's what we must see first. Any other issue must be a working. Because the comment here was prepare extra from the statement of the comprehensive income. So the first working is you have to find the cost of this machine. So cost of the machine, that's the first working. So any figure that you need, let's come here. Workings. Workings number 1. That is that the cost of what? Machine. Let's start. That one, don't forget your currency. The reporting in cities. So the item over there, we have to cut them. So the first one, purchase base price 1050 must be passed. So quickly, base price, which is 1 Commander Ladish. Then in that order. I'll be very fast because we have a lot of questions to solve and a lot of things to do tonight. So let's take note of that. Then the trade discount applied to the base price only is 20%. Okay. So trade discount must be subtracted. So 20% of the trade discount. Last word. Trade discount. That examiner. That is 20% times 1050. And that will give us 210,000, right? Take it off. Let me do it. 840. Look at 840. That's a payable amount. We call it payable amount. Then we quickly move again to pick the remaining one. Early settlement discount taken on the payable amount of the base cost only. No, this one, we should not touch it at all. Instead, it must go to the P&L to offset certain expenses. So if I should report about everything, this one goes to the P&L. Then you net it off against a particular expenses, or you treat it as a what? Other income. So I will net it off against any of the operating costs. So I'll call it what? I'll call it settlement discount 5% on the payable amount. The payable amount is not a 1050. Take note. The payable amount is this figure. So if I should put everything, I write the discount. We call it cash discount. In bracket 5% times 2, 840,000. Only the first year. You have to include it only the first year. Only the first year. So therefore 0.08 plus 0.05 times 840 will give us something like 42,000, right? Now, when they say prepare extract, you want everything. Don't select the one that you want and leave the other one. No, prepare extract from the above. So tell us where each of the items will be treated. That is all. Great. Then move on to the next item on the list. Treat charges. What are you going to treat it? P&L or capitalized? Might be capitalized. So free charges, 30,000 quickly. All right, free charges, 30,000. Quickly, we move on. Electrical installation cost will be part. Yes, installation cost must be part 88. Installation cost 28,000. Then we go again. Staff training, use of the machine. Staff training. No, staff training should not be part. It must be expense. So come here. Let us examine staff training cost should not be part of. So staff training cost 40,000 should not be part. I'm saying good. Must be expense here. The next item on the list, one after that, pre-production testing. Yes, it must be part. Pre-production testing 22, because there's a testing here. What we don't like is pre-production cost. Take note, we don't want pre-production cost. But pre-production testing should be part. So that's 22,000. So pre-production testing, 22,000. And let's quickly move on. The next item is what? Purchase of a 3-year maintenance contract. It means that after they acquire the machine, they also sign a contract or a contract that stated that the supplier should come and what? Maintain or service or repair the machine for 3-year period at the cost of what? 60,000. This should not be part of the cost of what machine, because to not make the machine ready for its intended use. If the machine is not good, no, we can't use it before they can maintain it. So that one must be expense. So pre-production, sorry, maintenance should be what? Expense. Let's go and expense it. Okay. So let's expense it in a P&L. All right, your maintenance contract is 60,000, right? Can you divide the 60,000 into what? 3 years. So 60,000 over 3 each year, 20, 20, 20. 20, 20, 20. And now it becomes a current asset to you and a non-current asset to you. The non-current becomes what? 20, current is 20. So this two becomes an asset to you. Why? You pay the people ahead of time. Okay. I am providing everything. This probably will be the scheme. Everything. Though under exam condition, you might not be able to be in the right capacity to provide for everything here. The next one is estimated residual value low. Don't need it. Okay, so we are done with the initial cost of the machine. Then we can start depreciation, right? Machine life is 6,000. So now let's sum all up. Let's sum all up and let us know the total cost of the machine. Okay, so 28 plus 22, that will give us 50. 50 plus 30, that will give us 80. 840 plus 80, that will give us 920. Perfect. So 920,000, right? That's the total cost of the machine. Then total cost of the machine. So depreciation must charge. Now here we are using machine hours. For machine hours, you need to find the depreciation per hour. So you have to divide the depreciable amount by the total machine hours or the total life. It's the same as straight line, but just that the life of the machine has been translated into what? Hours. That's all. That is the difference. So pick the cost, let the residual value divided by this to get a rate per hour. So let's do that quickly. So the cost is 920,000 minus residual value of 20,000, all divided by what? 6,000 hours. So please, what do you get? So this will give us any answer for us. That's 900 about 6,000. So that will be 3 away. 900 divided by 6. So 900 divided by 6 will be 150 per hour. Agreed. 150 per hour. Yes. So it means that each and every hour that they use the machine to produce goods to be 150 per watt hour. That's all. So 150 per hour. So that means if you want to know the total depreciation for 2012, just relax. Ask yourself, how many hours have they used the machine in 2012? That is all. Multiply by 150. And then you are done. So let's go to the question and pick those ones and quickly wrap up with this. So the first year, 2012, they used the machine for 1,200 hours. So what's the total depreciation? 1,200 hours, total depreciation. So total depreciation will be, well, let me write the depreciation here. 180,000. So depreciation, if you multiply, you show working 180,000. Let's go to the second year. How do you get 180,000? We multiply the 1,200 hours by what? 150 hour. Sorry, by 150 Ghana cedis. 2013 is what? 1,800 hours. So what do you get for that one too? So 1,800 by what? 150. Any answer for us, friends online? So 1,800 by 150. Any answer for us, friends online? Friends online. 270,000. Great. I'll pick that. So 270,000. Now, when you go to the last year, relax. Don't even continue. The last year, because there was some upgrade. There was some what? Upgrade. So in 2014, there was upgrade. So unless we consider this footnote before we can now go to 2014 only. Now, before that, let's provide the current amount. Let's go to the balance sheet and start writing something there. Yes, because what we've done, you can put them in the balance sheet. So let's go to the balance sheet. The balance sheet, I'll go straight forward. That examiner that non-current assets. First, I write the machine, cost of machine. At what cost? What's the cost of the machine? I write 920, right? Or 900. The cost of the machine. Will it be 920 or 900? Please, it must be what? 920. You only have to subtract the stock value when you're going to calculate depreciation. After depreciation, come back together. So 98,000. When you get here, relax, don't write anything there because there are some adjustments. So even if you cannot do the adjustment, not the first 3 years. Have you seen? Not the first 3 years. So take note. Accumulated depreciation. Accumulated depreciation will be. Accumulated depreciation will be. So depreciation charges 180. So let me bring it here, 180,000. I'm subtracting. When I come to the second year, what will the total depreciation charge? We've charged 180 in the first year, and we've charged 270 in the second year. So putting this together, what do you get? So 270 plus 180. So 180, that's 450. Perfect. I like that. Now let's get a current amount. The last year they leave it because of the adjustments. So even if you cannot do anything, not this. So what's the current amount? Current amount. So 920 minus 180, and then 920 minus 480. Okay, so the 740 for the first year. Then we take 270 from it. $470 for year 2. Okay, so we should change the place value. So that's the carrying amount of the asset. Carrying amount. Then you come to current asset, into brackets, prepaid maintenance cost. Because the maintenance that they paid is what? 60,000, and for 3 years. So after 2012, 11 was 40. So write 40,000 here. As of 2013, was 20,000. That's all. We are done. Or what leverage the last year. So if you cannot do anything, not those that have not required complex adjustments. Because I would say that anytime there was a very wicked king or chief in a particular community, at least one of his elders be very good. So if you want to get to the king, pass to the best elder or the best person. So like every exam, difficult exam question, there are some easy sections there. That before you solve the difficult one, pass through the easy ones first. That's all. Now let's go and then attack the notes. Let's go. And let's attack the notes. On January 24th, Samampa decided to upgrade the machine by adding new components at a cost of 200,000. Wow. This upgrade led to a reduction in the production time per unit of these goods being manufactured using the machine. The upgrade also increased the estimated remaining life of the machine as of January 1st, 2014 to 4,500. Great. Okay, before I go to that, before we solve that, this year, the current assets, I'm supposed to break it down. Now, this current asset is like prepaid maintenance cost or maintenance contract. The prepaid amount, the total amount paid is what? 60,000, and it's for 3 years. So if it's for 3 years, it means that the first year is consumed 20,000. So let me how much? Let me 40,000, and that 40,000 is a prepaid asset for you, or is a prepaid expenses. So it's a what? An asset, current asset. In fact, if you want to go into detail, you can break it down. That is 40 20 is non-current, and 20 is current. But I mean, I don't want trouble. I put all of them together as prepaid what? Maintenance contract, 40. Because as at the end of the first year, we've consumed only what? A year out of the 60, which is 20,000. So 20 out of 60 left is what? 40. Second, at the end of the second year, I have consumed what? 20 plus 20, making what? 40,000. No, I paid what? 60,000 already. So still left with what? 20,000, which will be what? So current assets, because it's a prepaid expense. And the last year, nothing pops up in the last year. Why? I put a dash there. Nothing pops up because we've exhausted it. Yes, we've exhausted the 3 years. I'll be getting very well. Why the maintenance contract we are treating like this? I'll be fine. Any other question again before we attack the strongest one? Okay, let's go and then attack the strongest one. So here they are just saying that if perform upgrade, and then the upgrade leads to what? Leads to a reduction in the production time. Wow, that's great. So therefore, we can what? Capitalize it. And they also increase the life to 4,500 remaining. So that is all. So in short, this is a capital expenditure which needs to be capitalized. Capitalizing means add to the current amount of the assets. So we have to add this to the current amount of the assets. So we have to add this to the current amount of the assets. That's all. So this 200,000 should be added to what? The current amount of the asset at the date of the upgrade. On January 2014, 1st January 2014, that's when the upgrade took place. Actually the same as what? 31st December 2013 upgrade. Yeah. Just one or a second different. Good. So that means we can pay the closing balance at the current amount. Where is it? So the current amount here is 470, right? So after the upgrade, we'll get what? After the upgrade, we'll add a 200 to it. So let me clean the bottom. The next workings. Workings number 2, upgrade, capitalization of the cost of the upgrade. So upgrade first current amount, which is 470,000. So upgrade or component 200,000, right? Now get 670,000. Perfect. What will be the depreciation? Depreciation. So therefore this is a cost. So depreciation will be, we need to get depreciation per hour. Now depreciation per hour will be something like, oh God. The depreciation per hour, let's go and pick the new useful life. The new useful life is what? 4,000. The remaining is 4,500. Now the scrap value is no longer 20,000, now what? 40,000. So take note. Please, the same example here, this 4,500 and this 40,000. We can also use what you call IAS 8. This is a change in accounting estimate. They've changed an estimate. This is not a policy. When you revise the useful life or you change the scrap value, you change an estimate. Okay. So don't forget to, okay. Yes, it reminded me that there was a question that we asked there and it's not submitted it. That's question number 3 and question 4. So it will be 670,000 less what? 40,000. All divided by 4,500. Please, what is the answer? In short, anytime you change the life of the asset or you change the scrap value, or even you change the method itself, if not change policy. You've changed what? An estimate, because all these three items are estimate. The method is an estimate, the life is an estimate, because you can't tell us the actual. The square value is an estimate. So that's 140, right? Confirm, right? 140 per hour. So now we can go ahead and calculate the total depreciation for the last year, 2014. You can pick the number of hours that they've used your machine. So in 2014, they used it for 850 hours. So if they use it for 850 hours, what will be the depreciation charge for that particular year? As usual, we multiply by 850, right? So let's multiply the 140 that we've had by 850. So depreciation for 2014 will be the 140 times 850. Any answer for us? $119,000. So let's put it in here. So let's go locate it on the face of the financial statement and put it in 119,000. Like it. But it's too small. Myself, I can't even see it. Too small. Let's write depreciation here. It's 119,000. Like this. Okay. Then let's find the accumulated depreciation. So here, how do you find the cost of the asset after the 2014? Two ways. I'll solve this section two ways. Kindly select one. Don't pick all the two. The examiner will not agree if you pick all the two. So 2014, the first method. For 2014, method 2. Let's do the first one, and then we move on to the second method. I will pick the new carrying amount or the new cost. This becomes the new cost. So from hence going, the new cost of the asset is what? 670. So I'll put a 670 here. What is the accumulated depreciation? Now, the accumulated depreciation is only the depreciation charge for that particular year, which is what? The 119,000. That is all. You take it off. Whatever you get is a carrying value. Agreed. So 670 plus 1190. That's 551, right? So the current amount at the end of the year will be 551,000. Okay. That's the first approach. Don't forget that you don't need to add this to this 450 and get the total accumulated depreciation. Why? Because you've already subtracted it before arriving at this figure. Obviously, you took the current amount. Now the method 2, you can still pick the 920. For method 2, the cost, you add the 200 plus the 920. So to be like this, the 920 plus the upgrade of 200, that will give us 1120. Agreed. So the cost will be 1120. Yes, that will be the cost, 1120. 1120. 1120. Okay. Then accumulated depreciation. This time around, you add the depreciation to the previous year's accumulated depreciation. Because here you picked the overall figure, so it must contain the overall depreciation. And that will give us 119 plus what? This 450, right? Accumulated depreciation, cumulative. 569, agreed. So 569. And it must give us the same answer. Let's give her the same answer. So these alternatives, how you can present them. How you can present them. Okay. Let's continue. Some questions on both subsequent and initial measurement. And I'll give a trial work on May 2018. Something happened. It was a tutorial mark for 4 marks. I will ask that question and let's continue again. Another question here that I want us to try. Questions also. Okay, so we are solving illustration 11. Illustration 11. Illustration 11. Then I have 3 more questions to solve right after this. Then we say bye-bye to IAS 16. 3 more after this one, 3 more questions. The rest, I'll parcel them nice and give it to you. This material, you have it. So I have another set of questions that I have to parcel them nicely for you. So make sure that you go through all this. If not, I'm not done it at all. Because if I'm not finished this one, then we don't need to call for additional ones. So last page 11. Okay. Show the relevant entries in the income statement for the year and the 31st December 2014 and estimate of financial position after the 31st December 2014 together with relevant extracts from PPE schedule. Okay, so continue to that. January 2011, ABC company purchased a freehold land and building for 800,000. The land is 240,000. Building is 560. The building was expected to have an economic useful life of 40 years, and the depreciation of the land is ignored. On October 2014, the land was revalued at what? 300,000 and 580,000. So something more. Prepare the entry. Yeah, I'll do the workings and then you do the entry for me, the extract. Let's go to the board and provide some few workings. Now you will do the extract. I'll provide all the workings that you need. So do the extract. Extract simple means both go to the P&L, both go to the balance sheet. There's a particular question that I have to solve that I'll be shooting. So first, the extract. So do the extract. So what goes to the P&L, what goes to the financial position, and do the workings. Now there's revaluation, so you need to calculate revaluation gain or loss. And after revaluation gain or loss, you just put them in. We need to also calculate depreciation to find the current amount. So let's start. It's land and building. Yeah, you can calculate them together and just calculate them together, or can just separate them. Any of them that's not correct. So let's do this. I'll put land here. I'll put building here. I'll put total. So Ghana city, Ghana city, Ghana city. What happened? Let's see something. The fuel land, 800. Land is 240, so the building. The building is 560. Okay, so that's the cost, right? So right here, cost of the building. Cost, land is 240,000. Building is 560. Together we have what? 800. Together we have 800. Second, the building was estimated to have a useful of 40 years, and the depreciation of the land is not. Okay, so 40 years, let's calculate depreciation. Let's find what we call accumulated depreciation. Now, accumulated depreciation simple means depreciation for a year. Let's multiply by what number of years you've traveled. Yes. Now, on October 2014, what's the accumulated depreciation up to October 2014? So we can calculate from where? January 2011 up to October 2014. How many years? So that we calculate depreciation for a year. Now, depreciation for a year will be the cost of the asset 560,000 over 40 years. That's all. That's the depreciation per year. Now times number of years they've traveled. That becomes what the accumulated depreciation. So let's see. Okay, so January 2011 up to 2011, 1, 12, 13, by 2014, when October 1st. October 1st. So it is the same as what? It will be 3 years, 10 months. I don't agree. So 1, 2, 3, yes. So it will be 3 years. 3 years. Any other trial? October is not part, right? Yes. So October is not part. So October will not be part because 1st of October. That means it's the same as what? 30th September. So September. So 3 years and what? 9 months. That's all. So multiply by 3 years and 9 months. So 3 years, 9 months. How do you do it? So write 3. Put 3 whole number here. That is. If you don't want trouble. If you don't want trouble, just find 1 year depreciation, multiply by 3. Can you divide the 560 by 40 for me? Can you divide 560 by 40? Let's get 1 year depreciation. You don't want trouble. 1, 2, 3, divide by 40. That's 14,000. Great. That means depreciation for a year is 14,000. Then 3 years will be 3 years accumulated depreciation will be equal to 14,000 by 3. Answer. So 3 years will be 14,000 times 3. And that will give us 30. So 42,000, right? Good. And then 9 months will be what? That is another to be 9 out of 12 times what? 14,000. So 9 months will be 31,150. I might not agree. I might not agree. 14,000 times 9 out of 12. 10,500. Yes, I think that 10,500. So therefore, the total accumulated depreciation will be, put the two together, 52,500, right? Perfect. So you come here and come and write this up. But if you want trouble for yourself, do this. 3 whole number, 9 out of 12. This thing, if the calculator is not yours, the answer will be wrong. It's like right. Let's prove that the calculator is yours. You can take somebody's calculator and use it. That's not wrong, unless it's your own calculator. Yes, unless it's your own calculator. Let's prove it. We don't want trouble. Multiply this one. Jump by 3. What do you get? Don't punch this on the calculator because if you don't punch it well, if you punch 3 like this and punch 9 and punch 12 on your calculator, it will give you different answers. That's not wrong. Unless you use the shift key plus the division, so that the calculator will give you 3 boxes or 3 boxes already, like this. If the calculator provides 3 boxes like this, that one answer will be correct. But the calculator does not provide the 3 boxes, you pick by yourself, the answer will be wrong. So take note. Or if you want to do something like this, just multiply, convert to what? Improper fraction. So 12 by 3, that will give us 36. 36 plus 9. 36 plus 9, that's 45. So in all, this is nothing by 45 out of 12. That's all. 45 out of 12. That's all. So give you the same answer. Then you sort the result. Okay, so let's continue. So accumulated depreciation, yes, dash. We don't depreciate land. Why is it that we don't depreciate land? We don't depreciate land because land does not have what? A useful life. Any asset that do not have a definite useful life, we don't depreciate them. Take note. Land is one of them. And even land, there are 2 types of land. We have what we call freehold land. Freehold land. Land that you acquired for yourself. You bought it. And then we have leasehold land. Leasehold land. In fact, we depreciate leasehold land. Why? Because you have leased it for a particular time, maybe 5 years. So depreciate it over 5 years. So take note. Leasehold land is the land that you've leased it and must be depreciated, or we call it amortized. Good. So accumulated depreciation is 52,500. I am subtracting. The same figure comes to 52,500. I'm subtracting. Please, what's the current amount? See it, a chartered accountant, or come again. So current amount here will still be 240,000. This one will be what? 560,000 less 52,500. That will be. And then you are doing the total two for me. So 560, 1, 2, 3. Less 52500. That's 50. No. 507,500, right? So 507,500. Then the total will give us 747. So 747,500. 747,500. Good. Then you bring the revalued amount to find the revaluation gain. So on October 2014, the land was revalued to 300,000, building 550,000. So what do you do? That examiner that revaluation. So revalued amount. You see here the revalued to 300,000. This one to up to 580,000. So in total 880, right? So what is the revaluation gain here? So this will be 60,000 gain. $72,500, right? So 72,500 average. In total, that will give us, so 60 plus this 132,500. Can you confirm the figures? 132,500. So that will be the solution. Okay. Okay, so it's calculated a revaluation gain. How do you treat revaluation gain in your books? Revaluation gain, how do you treat it in the books? Revaluation gain, how do you treat revaluation gain in the books? Accounting treatment of revaluation gain. That is what we have to look out for. Yeah. Okay. So added to OCI and to the current amount unless there were previous loss. Okay, I'll take that. OCI, okay, I'll take that. So that's all. So when you go to P&L, when you go to your P&L, the relevant extras look like this. P&L, please, the name of the company should come. The currency. First, depreciation. We are not done with depreciation. Now, we have the first 9 months depreciation. First 9 months. First 9 months. We calculated we had 10,500 for that particular year, 9 month depreciation. Then the last 3 months. The next 3 months will be open a bracket. It is a revalued amount. Have you seen the revalued amount here? It's a revalued amount because after revaluation, the asset value becomes what? The revalued amount. Then we divide it by what? The remaining useful life at that is. So if the asset will last for, let's say, 50 years and 40 years, and now we use 3 years, 9 months. So let me come. So how many years remain? How many years? How many years remain? We bought the asset for 40 years. We used 3 years, 9 months. So how many years remain? So 40 years less 3 years and 9 months. So 36 years and 3 months average. And 3 months. 36 years and 3 months. So therefore, the depreciation will be like this. Just bring the 580 here, 580,000, all divided by, convert this 36 years, 3 months. In fact, you can convert all of them into months. or you can also maintain it and convert to decimal. Because if you write something like 36 whole number, 3 out of 12. Should be like a trouble if you're calculating it. So find a way. 36 whole number, 3 out of what? 12. You can write it like this. 36. Divide this one. 3 divided by 12. What do you get? You get 0.what? 25. So there is 0.25. Just add it to it. So you get 36.25. So take note. So come here and come and put it in 36.25. Just divide this one. Sum it by your calculator. 3 months is the same as what? A quarter. That's 25%. That's 0.25. Add it to the 36 years. So 36.25. Great. Then you start with depreciation. Then you go to like this. Times 3 out of 12. Yes. Times 3 out of 12. So the next depreciation will be 580. 1, 2, 3. Divided by 36.25. And that is 160,000 times 0.25. That's what? 4,000. So 3 month depreciation is what? 4,000. That's the 3 month depreciation, 4,000. Right. 3 month depreciation is 4,000. Okay. Then what again do we need in a P&L? We need OCI. So right here, OCI. OCI. Then the gain. The OCI, you record revaluation gain. Here you put the two together. So 132,500. That is all. That down the P&L. Please and please again. If you write it like this and I don't see the OCI, I have every right to mark you down because you are classified among P&L. Don't forget that we said OCI is different from or it's separated from what? The P&L. So take note. I must see the OCI, other comprehensive income. Okay. So that is it. Let's continue the game. Now, if you go to the balance sheet, but the thing that I said that you do know, I find out you need to. If you go to the balance sheet, if you want to find the carrying amount will be like this. The carrying amount of the assets will be like this. Or let me prepare the PPE schedule. Let me just prepare the PPE schedule. If you want to find the carrying amount, we said that under the revaluation or the revalued amount, or under the revaluation model, current amount is equal to the revalued amount, great, less subsequent accumulated what? Depreciation. So this is the place that I will explain the word subsequent. So here, if I ask you to find the carrying amount of this asset for me, how do you get that? And let's see how best we can calculate that. So let me quickly take this section off. Let me quickly take this section off and do the current amount calculation. So to find the current amount of the assets, we said that I have land here. I have building and I have total. After examiner, revalued amount, land was 300. This one was 580. Total is 880. What is subsequent accumulated depreciation? Here is dash. Subsequent accumulated depreciation means depreciation after the valuation. Don't forget that we get it up to October, 1st October 2014. So depreciation for that 3 months is what you call subsequent. Subsequent to the revaluation, and that one is what? 4,000. So we can only subtract 4,000. We can only subtract 4,000. So therefore, the current amount will be 300,000 and 576,000. And that's the end of the game. You put answers together, you send it to the balance sheet. So that is the end of the game. Put answers together and send to the balance sheet. Now let me solve my next question. The next question will be Akuska. Yeah, this particular question, you try that one. Let me come here. There's a particular question here that we have to look at it. Akuska to, okay, you can do Akuska. Let's look at Akuska. We are doing the A. Akusika. Let me check. Just the A. In fact, the requirement is as for the above. As a financial controller who has just been appointed or engaged to help Akuska Limited to resolve these issues speedily, you are required to detail out the treatment of the above transaction in accordance with an appropriate accounting standards. So A, let's go to A. So it said that on January 1st, 2014, an asset has a current amount of 140,000, and the remaining useful life of the asset is what? A remaining useful life of 10 years with a no residual value. The asset is revalued on that date to 60,000. Wow. And the loss is recognized in the profit or loss. A loss of what? So 140,000 against 60, right? So that will be a loss of. So let's quickly go to the board. A loss of okay. So let's go to the board. After this question, let me my last one, and then ask for example or illustration 7 in the material. Can you try that too? Like illustration 7. Can you try that? Okay. Okay. Okay, so I just received a question, but we'll look at that at the tail end of the program. So we'll look at that question at the tail end of the program. Okay, now let's see. Now, first, the current value was current amount is 140,000, and revalued amount happened to be 60,000, right? So there's a revaluation loss. So revaluation loss of 80,000, right? Accounting treatment, number one. They've debited it to the P&L. Two, they've credited it to the asset carrying amount. That's all. That's the simplest accounting treatment. So let's see, let's continue the game. And they're saying that the loss is recognized in the P&L. Wow, they've debited it. The asset is depreciated. Okay. Now, the asset is depreciated on straight line over the next 5 years. Even the current value of 30,000. Wow, this is not very good. It has given us a current value of 30,000. So the next 5 years, they have depreciated it and given a current value of 30,000. How do they get the current value of 30,000? Okay. So it's like this. Now, the costs or the revalued amount happen to be 60,000. What's the accumulated depreciation? Let's calculate it. Let's prove the 30,000 because I'm not going to give you that figure for free. That 30,000 was depreciation will be 60,000 all over 10 years. Let's say after 5 years, so times 5, right? And that'll give us 30,000. So current amount is 30,000. Now, if you take this one off, so that means the current amount is what? 30,000. This becomes the current amount. Don't forget that we said something that after revaluation, the asset current amount is nothing but a revalued amount, which is what? 60,000, less what we call subsequent accumulated depreciation after valuation. Okay, so let's continue the game. Now let's go to the final aspects to this question. Then on 31st December 2018, okay, we've done that. Then on January 2019, that's the next day, when the remaining useful life is the unexpired 5 years, the asset is revalued to 72,000. Wow. The asset is revalued to 72,000. So let's have a revaluation gain or loss. This is 5 years ago. So as at 1st 2019, let's go and pick the date up. 3rd January 2019, which automatically the same as 3rd January 2018. So we are safe. So as at 1st January 2019, We are calculating what? Revaluation gain or loss. How do you get it? Add a figure here. Then you bring the revalued amount, which is 72,000. You bring the current amount at the date of valuation, which is the 30,000 here. So bring the 30,000. You take it off. Then here will be 42,000, right? And that is revaluation gain, right? Revaluation gain. So there's revaluation gain of 42,000. How do you treat this gain? Here we are. We just want to test the understanding of what? Previous loss. There's a revaluation gain of what? 42,000 currently. But the same asset gave us a revaluation loss some time ago, etc., or exactly 5 years ago. So how do you treat this gain in apples? We are saying that revaluation gain, the treatment is so simple. Number one, just debit your assets. Number two, just credit what? Your OCI or revaluation surplus, except for there was a previous loss. Here too, there was a previous loss that we have to reverse. Until the entire loss is reversed, there's no gain. That is all. So let's see the accounting treatment. So here, the previous loss is what? 80,000. Current gain is what? 42,000. So how do you treat this? So let's provide a relevant extract. So I'll do the extract here. So first, in my P&L, I'll go there and tell the examiner that revaluation was gain, which is 42,000. In fact, I'm reversing it. Nothing goes to the OCI. Why? Because all the gain have been used to offset the loss. We still even have 80,000 of the loss. That next time when we have any gain, we offset it. So the next time when we have any gain, we offset it. So that is it. So in short, here instead of us crediting the OCI, rather credit to the P&L to offset the higher or the previous loss. That is all. So this is the accounting treatment. The entire gain should be credited to P&L, and then the gain should be added to the current amount of the assets. Kindly take note of this. We like it. And then I will treat it again when I look at impairment loss. Now let me look at my last question. We call it deferred tax on revaluation. This one I'll go to the previous notes. Then I promise you that another tax, we said I will treat deferred tax on revaluation when you go to here. I want to go to IAS 16. So now we are here, so I have to treat it. So let me go back and solve that particular question one. Then I'll produce a material on the platform. Can we do as if you are doing or not doing, and then treat it for me? Okay. So let me upload that. Okay, so let's look at this. Let's go. The last, I think it's the last question, yeah. The last question in the material. Yes, so I'm solving question 8. I'm interested in the revaluation section. Okay, so let's look at this particular question. When there's a revaluation gain, so let me explain it here before we pick this question to seal it. Actually, take note of that. When there's what? Deferred tax on revaluation. Oh, I've done it. Deferred tax on revaluation. That is where deferred tax on revaluation. Wherever the gain or wherever you treat the revaluation differences, the tax must follow. That is all. So let us know if I had a gain of, let's say, 42,000, and that's revaluation gain. And then the tax rate, your tax rate is, let's say, 20%. So wherever you are going to treat this gain, kindly treat the tax, find the tax component. So 20% on this, that will give us 8,400. So wherever this 42,000 will be recorded in your books, the tax must also follow. And take note of this section. If it is for reversal, the same thing. Wherever the revaluation gain, you are treating it, let it go. So for instance, this particular question, the revaluation gain was going to the PN, it wasn't going to OCI. So this is how it will be. Then I go to my P&L extract. My P&L extract, after the time now revaluation gain, in bracket reversal, 42,000. I said deferred tax on valuation. Deferred tax in bracket 20% on the value is 8,400. I'll take it off, times off. So wherever the gain is going to, if the gain moves to OCI, the deferred tax can also go to OCI. That's all. Yeah, done. So now let's go back to treat this particular question. That's I'll be fine and fully. We move on to IAS 40 and IAS 20 today, if possible. Okay, great. Optional, let's do this. Let's see this particular question. Okay, so we are saying that wherever the revaluation difference is being reported, the respective tax must follow it. So if the revaluation is going to OCI, you write revaluation gain, maybe it's 42,000. Oh, deferred tax on it, 20%, 8,400. That's all. And don't forget that whatever enters there, OCI also goes to change in equity. So again, to reflect in change in equity. Good. So that is that. If we go to the P&L, the same thing. So we are going to use this question to pack it. So you're saying that prepare extract of the financial statement showing the effect of the above transaction. Now pay maximum attention to this particular question so that we use it to illustrate all the questions. We are preparing extracts. So it means that what goes to P&L, what goes to financial position. So we're going to prepare the extracts. Name is Simon Limited. So Simon Limited extract. When I ask for extracts, what goes to P&L, what goes to balance sheet. So the name of the company, sorry. Statement of So let's make it income statement. And then this is still Simon. This is the financial position. Or the financial position should go on top a little. But it's an extra. So statement of financial position. Please no shortcut to my Ghana city, my Ghana city. Have you seen? Okay, so there's a question here for us. Let me voice out the question. Someone asked that. So the tax should be on the valuation. Yes, please. The tax must be on the valuation. That one different from income tax. Yes, it's slightly different from the income tax, and we are going to calculate it. We are going to do this question to explain it very well. And this question will tell everything. Yes, to make sure that you grab every part of this question. Every part of this question, can you grab it? Every part of this question. So that I'll issue a final account, a publication, where in that publication, there was these sections, a lot of them are in it. I'll upload that particular question on the platform and indicate the question numbers that have the deferred tax on revaluation, so that you do that one for me, just the revaluation section alone, I'm done. So there are like 5 questions, 5 publication questions that you do those revaluations. Oh, I've seen this one. So they say on January 2018, Simon Limited revalue its land for the first time. Wow. A qualified property valuer reported that the market value of the land on that date was 80,000. The land was originally purchased 6 years ago for 65,000. So is there any revaluation gain? Okay. The required provision for income tax for the year ended 31st December 2018 is 19,400. So that's what current year tax provision. Good news. The difference between the current amounts of the net assets of Simon, including the revaluation of land in the notes above, and their tax base is 31. Sorry. As at 31st December 2018 is 27,000. Okay. The open balance of deferred tax was 2,600. Simon's rate of income tax is 25% required. Let's go to the board. First, let's calculate the revaluation gain, and let's calculate the income tax expense. So let's do the workings here at this side. Don't forget that when we ask for extracts, asking for what goes to P&L, basically what goes to the financial position. Okay. Now, first working that I'll do is revaluation gain or loss. That's the first working that I'll do. So the first working should be workings. That examine now. Workings 1. I'm going to calculate whether there will be revaluation gain or loss. So first, revalue the amount was 80,000. Current amount at the date of valuation is 65,000. So is there any revaluation gain or loss? There's revaluation gain of what? For this particular question, I'll prepare everything. So can you make sure that you get everything, every part? Okay, so what do you get? 80,000 minus 65. So probably that's give us somewhere 15, right? So there's revaluation gain of 15,000. Revaluation gain of what? 15,000. We are done. Now, second, how do you treat revaluation gain in our books? Don't worry, third examiner. Number one, add it to the carrying amount of the assets. Number two, add it to OCI / what? Revaluation surplus. So let's go to our OCI and then put it in. The right OCI here, but I'll got something here. Have you seen the OCI? I hope you are getting it right. Let me put the OCI here. Underline it. I've left some space here. And right, revaluation gain. We said it must go to OCI because that's the first time. Again, it's 15,000, right? And after that, now deferred tax. Deferred what? Tax on the gain. Deferred tax will be, open a bracket, or the tax rate of the company. Simon tax rate is Simon tax rate. Simon's tax rate happen to be 25%. So that's the tax rate. 25%. Now let's find 25% of 15,000. What do you get? 3,750. 3,750. Good. So you put this in brackets. You can find the net answer. Yes, that's the net of the OCI. I'll get it. That's the first thing that you do. Wherever the revaluation gain will go to, please let the tax flow. So the actual revaluation gain is what? Net of tax is 11,250. Okay, that's great. Let's continue the game. Now let's go and calculate the income tax. Almighty. The income tax expense. How do you calculate the income tax expense? So that's working number 2. The income tax expense. Now the income tax expense, we say it's made up of C, U, or O, and then a D, right? Current year, and then over and what? Deferred tax. The deferred tax is the movement. Let's go and pick the current year tax from the question. It was given to us free of charge, which was stated that, yes, 19,400, right? As the current year tax, 19,400. So current year tax, 19,400. Added over, we don't have added over, so dash, or I'm not even bringing it at all. We don't have it, so I shouldn't bring it. We have deferred tax in this question. Let's go and calculate deferred tax. We say is the movement, so I'll do that again here. But for balance sheet, let me clean it for now. I'll bring it back again, okay? When it's number 3, deferred tax calculation. This is where the trouble is. Kindly take note of this. Working number 3, deferred tax. Write the opening balance here. The opening balance is from the question. Let's go and pick the opening balance. Opening balance for the deferred tax happen to be 2,600. Okay. So let's go and write it. And that's to be 2,600. What again? Leave a space. Then write the closing balance. Closing balance. Go and do your workings. Open a bracket. Now, so the closing balance is the temporal difference times the tax rate. Temporal difference times what? The tax rate enacted or subsequently enacted. The current tax rate or the tax rate subsequently enacted by the government. Now, a temporary difference, please and please again. Please and please again. Kindly make sure that the temporary difference, it excludes the revaluation gain. This guy. Make sure that the temporary difference excludes what? The revaluation gain. Because we have already treated this revaluation gain, the deferred tax on revaluation in the P&L already, in the OCI already. So if that temporary difference is given to you, the examiner have made it clear that that temporary difference includes this revaluation gain. Please, I'm begging you, take it off. I'm begging you, take it off. Or there's alternative workings, but this one is a bit okay. Take it off. So let's go and see whether they did that. There's something here. The difference between the carrying amount of the net asset of C1, including the revaluation of the land. So the difference, so in short, the difference between the current amount and then the tax base happens to be 27,000. So that's the temporary difference. And this temporary difference includes what? The 15,000 valuation gain. So you have to take it off immediately. So 27,000 less 15,000 before we find the deferred tax provision. You have to take it off. So take note. 27,000 minus 15,000. We are taking it off immediately. Now times 25%. Please, what do you get? Now do 25%. So 27,000 less 15,000. That should somewhere 8,000, right? It's 3,000 and by 25%. So that's 3,000. Good. Just 3,000. So what's the difference? The difference is 400, right? Right here, income tax expense. The difference moves to income tax expense, 400. What should I add to this figure so that I can get this? I have to add 400 to it. That is all. Okay, let me prepare the balance sheet extracts. And then we are done. So here, I'll put the 400 here. I'll put them together. It's positive here, a same figure. So 19,800. This one taken to P&L. When I come to the P&L, income tax expense will be, now right here, income tax expense. Income tax expenses, 19,800. That is all. What level is the balance sheet? Now, the balance sheet, watch carefully how we treat this. How we treat this. Watch carefully. Alternatively, so far, how to arrive at this figure? Alternatively, we can go ahead and multiply 27,000 by the 25%. But don't forget to subtract this 3750 from that particular answer. So then I like the first method. So 27,000 times 123 times 0.25, that'll give us 6750. Now this answer now minus what? Less 3750 must give us the same 3,000. So take note of that. Okay, let's go and do the balance sheet extra. Then we are done with IAS 16 and 12. So I'll do the balance sheet here. Just here. So the balance sheet look like this. So financial position extra. First, non-current assets, NCA. I write the land. We don't depreciate land. So the value should be 80,000. I'll go to equity. When I go to equity, please, whatever enters the OCI also enters the balance sheet through change in equity. So I write a revaluation surplus. Revaluation surplus. I'll pick the net of tax. Net of tax is 11250. Net of tax. This particular figure, net of tax. Then I'll go to non-current liability and write deferred tax. Deferred tax. Now over here to just be careful. Over here with the deferred tax, we normally like the closing balance, right? We normally pick the closing balance. Normally we pick this closing balance, this 3,000. But this 3,000 does not include the deferred tax of what? The revaluation. So now you open up brackets. The normal deferred tax of 3,000 closing balance, so that's the one not you calculated on the deferred tax, 3750. So at the end of the day, you get 6750. And they get 6750. So that is the end of IAS 16, the question solving stage of IAS 16. Great. If you do have any question, kindly ask before we close the chapter of IAS 16. Once I will send a question on the platform. Sorry. So how do you treat this particular question in your book? Start work. Buys a dog for 30,000, let's say, dollars of cities for security. For security. How are you going to treat in your books? How can you treat this in your book? Okay, so let's see. Can you put all your answers to me? I pick them up. Thank you. So now we can go to IAS 40. Can I go to IAS 40? Dogs applied for security. What is the accounting treatment for dogs applied for security? Okay, so in simple quotes, we define PPE are tangible non-current assets or tangible assets. And we define assets as economic benefit, valuable, including what? Dog, yes, valuable. Owned and controlled by an entity. So the dog will be owned by the entity. And then controlled also by the entity. Control simple means the entity will give command to the dog and the dog have to respond. Second, control also means the benefits of the dog will move to the entity. That is the control that we are talking about. And in all cases, it's true. The economic benefit will move to the entity. Now, before you can record PPE or assets in the books, two conditions must be satisfied. So, and the cost can be measured reliably. The cost of what? The dog. In this case is what? 30,000 cities. The cost can be measured reliably. Now, in short, to record the dogs as the assets in the books, preferably PP. One, future economic benefits must be possibly flowed to the entity. And here, yes, the dog will provide security services, and that is the benefit. Dog will save the entity some cost. Then the point 2, the costs involved can be measured reliably. So the cost of the dogs can be measured reliably. Now just take like if you acquire CCTV cameras and then if you install them, you quantify them and then capitalize as what? Computers and equipment, right? For security. Are you using the dog? So it's the same as dog provide the same security. Unless you're going to buy the dog and read them. If you're going to buy the dog and read them, please, that one is not PP. You're going to buy dog, read them for sale. No. That one is moved to what you call IAS 41, agriculture. IAS 41, agriculture. And it's called a better biological animal. And it's a PP. Better biological animal is PP. That is all. So that will be classified as what PP in the books. And it should depreciated over the life, yeah, estimated useful life of it annually. Yes, annually. Estimated useful life of the dog must be estimated reasonably and depreciated over the life. Okay. Yes, because the entity have a full control over the dog. Full control. Please, if they employ human being as a security, you can't capitalize human being. Why? Human being, the entity does not have full control over human being. And the cost of human being cannot estimate reliably. The salary that you pay the human being cannot acquire the human being forever. The salary that you pay to the human being cannot acquire the human being forever. So therefore, the cost of the human being cannot be determined reasonably. 2, for the dog, if you pay 30,000 for it, that's all. You've acquired the dog forever. If you pay 30,000 to a human being to guide your facility for you, you've not acquired the guy forever. So you don't have control. That's all. We are done. Wait, that's the end of IAS 16. But let me explain this. We have what we call where is it? Good. We have what we call PPE schedule. So can you study it well? PPE schedule look like this. It talks about all your PPEs in column by column and their total. So the cost of the PPE, you start with the cost, the open balance. So this is the open balance of all of them, and then put a total here. Any revaluation gain, if it's a revaluation gain, you add. If it's revaluation loss, you subtract. Because we say revaluation gain, add it to the asset value. So we are in here. Additions, like you purchase, acquisitions of assets. And then disposal, you dispose of assets. And then you get your closing balance. Then you relax a while and come and write accumulated depreciation. And now you start the open balance on the individual assets. Then the charge for the year, the depreciation that you charge for that particular year, add into it. Then eliminate or cancel all the accumulated depreciation on the disposed assets. So that one you subtract, put that one in brackets. Can you put it in brackets? And you get a closing balance of what? The accumulated depreciation. Then how do you find carrying amount? So closing balance of the cost and the closing balance of what? Accumulated depreciation. That's to give us the carrying amount. The total figure is what we send to the balance sheet or the financial position. For a company, you have to do this PPE schedule somewhere. So if any of the examiner asks for PPE schedule, this is what we are looking for. Take note of that. Wait. So on that note, we are done for IAS 16 fully with some questions solved. Can you continue again? And I'll send the second set of the questions on your page for you. Great. Kindly subscribe to the channel if you have not done that and share the links to your friends.